Welcome to TalkTickers. You're here for the essential insights from the latest earnings calls, and today we're diving deep into the recent report from a company operating in the restaurant technology space.
Yeah, they certainly kicked off 2025 with a bang. Results came in ahead of expectations pretty much across the board.
Okay, so what are the headline numbers?
Well, first off, location growth was impressive. Over 6,000 net new locations added just in Q1.
Wow, 6,000, okay.
Yeah. And their recurring growth profit streams, the subscription and Fintech side, that jumped 37% compared to last year.
37%, that's substantial.
It really is. Adjusted EBITDA hit $133 million. GAAP operating income was $43 million.
Gotcha.
And because of this strong start and what they're seeing already in Q2, they've actually raised their full year outlook for 2025.
Raised the outlook. What does that look like now?
They're expecting more location net adds for the full year than they previously thought. They're even calling for a record quarter for net adds here in Q2.
A record quarter in Q2, okay.
And for the full year, they're now projecting Fintech and subscription gross profit growth to be around 26%.
Right.
And full year adjusted EBITDA landing around $550 million, which translates to a pretty healthy 31% margin.
Okay, 31% margin. So let's unpack that start a bit. Over 6,000 locations in one quarter. I mean, what's really driving that momentum?
A lot of it is still the core U.S. restaurant business. It just keeps performing well. They talked about high win rates against competitors.
Why are they winning so much, do they say?
They put it down to two main things. Their vertical platform approach being specifically built for restaurants and having effective teams right there in the local market.
Makes sense. Boots on the ground.
Exactly. And they also mentioned sales AE productivity for new bookings was actually up year over year. So good execution there.
You mentioned that vertical platform approach. Can you expand on that? Why is that such an advantage for them?
Sure. It means their whole system, from ordering and payments to kitchen displays and management tools, it's all designed just for the restaurant environment.
Right, not a generic software trying to fit in.
Precisely. It allows for deeper integration and more specific features than maybe a more horizontal player might offer, and they're constantly adding to it.
Like what kind of features?
Well, they mentioned focusing on things like more language support, developing membership features for businesses like wineries or clubs.
Oh, interesting. So branching out beyond just traditional restaurants.
Yeah, and handling complex entertainment concepts too, which actually leads into a big win they highlighted, Topgolf.
Topgolf. That's a huge name and quite different from a standard restaurant.
It really is. It shows the platform's versatility, right?
Yeah.
Handling large, complex operations with both food and beverage and this integrated entertainment side.
What specifically appealed to Topgolf?
Things like their handheld ordering and payment devices for the golf bays, the kitchen display systems, KDS, and importantly, the multi-location management tools for overseeing everything.
Got it. Okay, so strong core growth, expanding capabilities. What about those newer markets you mentioned earlier? International, retail, enterprise.
Yeah, that's another key part of the story. They're on track to actually surpass 10,000 locations across those newer segments sometime this year in 2025.
10,000 combined. That's significant scale building up.
Definitely. And the enterprise momentum is really noticeable. That Applebee's win is huge. It's their largest ever in terms of the number of committed locations.
What parts of the platform are they using? Applebee's, I mean.
Primarily the handhelds, the kitchen screens, and the enterprise management suite for oversight.
Okay. And retail, how's that vertical approach working there?
Good progress, especially in food and beverage retail. They mentioned the features like inventory linking being really valuable.
Inventory linking, like connecting sales to stock levels automatically.
Exactly. They gave an example. Beer on the Wall, a retailer, apparently cut down their inventory management time significantly using the platform.
That's a tangible benefit. What about international?
Also, strong momentum. They've been rolling out more of their platform features internationally, things like loyalty programs, email marketing, guest databases.
So bringing the full suite abroad.
Right, which they say is leading to better guest engagement in those markets.
Okay, this is all really interesting. It feels like the platform itself is getting smarter, not just bigger. Which brings us to AI, right? TOST IQ and Suchef.
Absolutely. This is a big theme. They're seeing customers adopt more and more parts of the platform, and they clearly view AI as a massive opportunity to accelerate things and differentiate.
So Suchef, that's the AI assistant. How's that going?
It's in a pilot program right now, but they said early results are promising, helping operators with, business insights, troubleshooting, managing daily tasks.
An AI assistant for the restaurant manager?
Kinda, yeah. And then there's TOST IQ, which is maybe broader. It's the underlying AI engine they're building to power features across the whole platform, infusing it with restaurant data and expertise.
Are there live examples of Toast IQ benefits yet?
Yes, a couple. Mission Boathouse used an AI tool for menu upsells and apparently saw a 6% lift in average order value.
Wow, okay. Tangible results again.
And another place, Celpe's Tacaria, is apparently getting strong ROI from an AI-powered advertising tool.
So the goal here is make the platform easier, more powerful for busy operators.
That seems to be the core idea, leveraging AI to save them time and surface insights they wouldn't otherwise get.
Okay, let's circle back to the financials for a moment. You gave the headlines, but any other metrics that stood out in the details?
Yeah, a few things. Annual recurring revenue, ARR, that grew 31% year over year. Pretty solid.
31% ARR growth.
Okay, the combined fintech and subscription gross profit grew even faster, 37%. And drilling down, subscription revenue itself was up 38%, and its gross profit grew 45%. Really strong margin expansion there.
Subscription margins improving nicely then.
Definitely. On the payments side, payments ARR was up 31%, fintech gross profit up 32%. So good growth across both recurring streams.
What about gross payment volume, GPV?
GPV hit $42 billion, which is up 22% year over year.
Okay.
Though interestingly, GPV per location was actually down 3%.
Down. Any reason why? Mix shift, maybe?
Could be. Maybe newer locations starting smaller, or just a different mix of business types. They didn't elaborate too much. The net take rate on payments did tick up slightly by 3 basis points to 48 basis points.
Okay. And the other fintech stuff, Toast Capital.
Yeah, the non-payment solutions, mostly Toast Capital lending, brought in $47 million in gross profit. They said it's performing well, good origination growth, stable default rates.
And expenses. You mentioned investments.
Right. Operating expenses, if you exclude bad debt, were up 12%, mostly driven by sales and marketing investment, which makes sense given the location growth. R&D and G&A costs were basically flat.
So investing in growth, but keeping other costs in check.
Seems like it. And that resulted in that adjusted EBITDA margin hitting 32%, which, as they pointed out, gets them to their medium-term targets ahead of schedule.
Impressive. And cash flow?
Free cash flow was positive $69 million for the quarter. They expect it to generally track alongside adjusted EBITDA for the full year. Oh, and they also bought back $17 million of their shares in Q1.
Okay. Solid financial picture. Now, looking ahead, you mentioned they raised guidance. What are the specifics for Q2 and the full year again?
For Q2, they're guiding for total subscription and fintech gross profit growth between 26% and 29% year over year. Adjusted EBITDA expected between $130 and $140 million.
Okay.
For the full year, that revised guidance implies around 26% growth in that combined gross profit bucket, and the adjusted EBITDA target is now around $550 million, hitting that 31% margin.
And that guidance assumes... What about the economy?
It assumes consumer trends basically stay stable, consistent with what they've seen recently. It also factors in slightly higher costs from tariffs on hardware.
Right, tariffs. We'll come back to that. But overall, they sound confident.
Yeah, very confident in delivering both strong top-line growth and expanding profitability this year.
Let's talk about those big enterprise wins like Applebee's and Topgolf. How do they think about the economics? Are these deals profitable quickly?
They emphasize that they manage these deals based on total payback periods and the unit economics. The key metric is really the ARR growth they secure.
So it's about the long-term recurring revenue stream.
Exactly. And because the ARR booked with these large deals is so significant, they view the paybacks as, quote, very attractive.
And do these big clients stick around?
Generally, yes. They mentioned LTV to CAC, lifetime value to customer acquisition cost is usually healthy for enterprise customers because churn tends to be lower.
Makes sense. Do they always get the payments processing with these big deals?
They said payments are attached in the, quote, a vast majority of their enterprise deals. So yes, usually.
Okay. Shifting gears slightly, the macro environment. They said stable trends, but are they seeing any signs of stress?
They explicitly said same-store sales and consumer trends have remained stable year to date, consistent with recent quarters. Nothing new there.
What about new restaurant formation?
Also stable, they said. So the overall environment seems steady from their perspective, and they feel equipped to manage based on that.
And pricing, is that a big lever for them going forward?
They framed ARR growth as the main focus, with pricing being a sort of smaller component of that. They're aiming for a balanced approach, considering customer impact while hitting their plans.
Okay, let's go back to AI, Suchef. Toast IQ. How quickly is this stuff rolling out, and how are they planning to, make money from it?
Still very early days is the message. The immediate focus is on enabling the whole organization with AI and demonstrating value to customers first.
So prove it works before charging for it.
Essentially, yeah. Toast IQ is that foundational engine. They see the value already with those upsell and marketing tool examples we discussed.
And Suchef, what's the bigger vision there?
They envision it as a kind of co-pilot for the restaurant, using data insights, having a chat interface for operators, maybe even helping support teams or managing back-end configurations eventually.
A true AI assistant, then.
That seems to be the goal. Monetization, they said, is something they'll consider over time, but the priority now is driving impact for the restaurants.
What about international? You said momentum is strong. Is it looking similar to the early U.S. days?
They suggested the early trends are similar, yeah. And interestingly, potentially higher GP per location than maybe some industry averages over there.
Higher GP per location. Why might that be?
Maybe the types of restaurants they're landing or the product attach rate. They didn't specify exactly, but they said progress is ahead of plan across their international segments. Customer sentiment is strong.
Are they getting referrals internationally yet? That was big in the U.S.
Still early stages for referral channels in those newer markets, they indicated.
Makes sense. And competition. Always a factor.
Their focus seems internally driven to just keep innovating, build the best platform. They did highlight their local strategy, focusing on bringing guests into the restaurant as a differentiator.
Okay. Given the economic uncertainty that's always floating around, how prepared are they if things did take a downturn? Recession planning.
They pointed to their experience navigating, the pandemic and other dynamic times. They reiterated they haven't seen consumer trends change yet.
And restaurants themselves?
Historically, pretty resilient across different macro cycles is their view. But they did say if economic pressure really mounted, they're prepared to pull back on spending that isn't directly driving revenue while still keeping that long-term view.
Okay, sensible approach. That enterprise pipeline Applebee's, Topgolf, has that momentum continued?
They said the pipeline is stronger than ever, actually. The recent big wins seem to be attracting more interest from other large brands. They're actively in talks.
What's the pitch to these big chains? What makes them switch?
Key things seem to be the quality of their handheld devices, the kitchen management tools, and the capabilities for managing operations across many locations. Sometimes they're replacing older in-house built systems.
Gotcha. And the software ARPU, the average revenue per user on software, seems strong.
Yeah, they attributed that to good execution by the team and that consistent focus on growing ARR.
Now, you mentioned hardware tariffs earlier. How big of a deal is that?
We said the incremental costs from the current tariffs are manageable and already baked into their updated guidance.
Have they done anything to mitigate that risk? Supply chain.
Yeah, they mentioned ongoing supply chain diversification efforts have reduced their reliance on China over time. If tariffs change significantly, they'll consider pricing holistically.
Okay. That location growth algorithm, is it mostly new restaurants opening, or are they taking share from competitors?
Still a mix, relatively balanced between new openings and competitive takeaways. The core U.S. business is the main engine right now, but they expect those newer TAMs, enterprise, international retail, to become bigger contributors over time.
Let's revisit Topgolf quickly. That win seems quite significant strategically.
It really does. Shows they can adapt the platform for these non-traditional formats. Competition in those specialized segments is often older, legacy on-premise software.
So they're powering food and beverage, retail. What else at Topgolf?
Potentially other aspects too, maybe even things like managing tea times down the road, though they didn't confirm that specifically. It aligns perfectly with their strategy to expand their total addressable market into wineries, clubs, these sorts of places.
And Topgolf locations are big, right? Does that mean higher GPV per location?
You'd certainly expect so, yeah. Larger venues, higher volume.
One last check, Toast Capital, the lending arm. Any signs of stress and the creditworthiness of their borrowers?
They said the program's performing well. Originations are healthy. Defaults are in line with their expectations. No significant changes noted in the credit quality of the average restaurant in their program.
Good to hear. And with Applebee signed up, any chance they might land IHOP, the other Dine Brands name?
It basically said they're actively exploring opportunities with other brands, IHOP included potentially, and reiterated the enterprise pipeline is strong.
Okay, that covers a huge amount of ground. Excellent detail.
It was a dense call, lots happening.
All right, now for our signature segment, This is not financial advice. Time for an outrageous but plausible trade idea based on everything we've just discussed. What have you got for us?
Okay, so thinking about that strong enterprise momentum, Applebee's, Topgolf, and their push into adjacent hospitality. Here's a thought. You could consider a long position in this specific restaurant tech company.
Okay.
But to hedge against broader sector worries, particularly potential headwinds for smaller, independent restaurants who might struggle more in a tougher economy, you could pair that long position with a short position in an ETF that specifically tracks those smaller, independent restaurant operators.
So bet on this company's ability to win large clients and diversify while betting against the more vulnerable end of the market.
Exactly. The thesis is their platform strength and enterprise TAM expansion drives outperformance, even if the little guys face pressure. But, and this is crucial, this is purely a thought experiment, a hypothetical.
Absolutely. Not investment advice in any way, shape, or form.
Definitely not. Do your own research, talk to a professional. This is just connecting some dots based on the call.
Understood. Well, that was a really comprehensive deep dive into this restaurant technology company's latest earnings call. We hit the strong growth, those key wins, the AI developments.
Covered a lot of ground.
Hopefully this gives you, our listener, a much clearer picture of the key takeaways and where the company is heading strategically. What stood out most to you? What questions do you still have? Definitely worth digging deeper if you're interested.
Sure.
Join us next time on TalkTickers, where we'll unpack another crucial earnings report.